Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri and I'll be taking you through alternative investment analysis. We are looking at November 2015, question 3. Question 3A reads as follows. Kiratia Kindika is a chief investment officer of a pension fund which allocates a substantial portion of its assets to private equity. The existing private equity portfolio is made up of large buyout funds, mezzanine funds, and a limited allocation to special situations fund. The pension fund decided to further increase its allocation to a venture capital. Required in relation to the above statement, summarize 4 differences between venture capital and buyout investing. So the examiner wants us just to distinguish between venture capital and buyout investing there. So we are looking at November 2015, question 3. Question 3A, now we can be able to provide a description or a distinction between a venture capital and buyout. But before that, we first of all need to have an understanding of how private equity actually works. And these are investors and who pump money into the private equity fund like that, and or firm. And this private equity firm are deemed to be experts or individuals with that expertise of trying to identify companies to actually purchase. And once they invest like that, now by extension, these investors through the private equity fund firm are able to invest in portfolio of companies. Now, one of the key things that private equity firms do is to try and identify firms which are rather small. When I talk about small, I mean small in terms of the asset base. And the asset base for, say, for example, venture capital fund or for startup companies are considered to be very small. Startup companies may not have the enough assets or substantial capital to enable them access financing from public means or through an IPO. So what happens is that private equity firms usually invest in those venture capital firms so that they can try and re-engineer the business processes and try and transform those companies to become profitable. That is what we're saying. They are able to identify venture capital firms. On the other hand, the private equity firms can go ahead and buy out other companies if they feel that they can be able to provide additional revenue or additional value. And later on, once they exit, they are able to realize a return on investment, a significant return on investment there. So that is how private equity firms actually consider investing in portfolio of companies. The first case is through venture capital firms, and the second case is through outright purchase or through a buyout. Now, we can now provide a distinction between the two on the back of that brief explanation. So we have the characteristic. Here we have venture capital. And then we have buyout. That. So the first characteristic that we'll be looking at to try and distinguish venture capital and buyout is customers. 1, customers. For venture capital firms, there is low predictability. We can say low predictability as far as the customers are concerned, with unrealistic projections, unrealistic projections of the customers' projections. There. On the buyout side, we can say the customer base is usually stable and predictable. That's the first distinction. The second characteristic that distinguishes venture capital firms from buyout funds is the product market. Number 2, market. we can say that here there is a new product market, new product market with uncertain future, Yeah. On this other side, for the buyout side, we can say strong market with possible niche market, what we can be able to say target market there. The third characteristic or distinction is the asset base. Number 3, asset base. You of course expect the asset base for venture capital firms to be weak. So we say this is weak. Here is substantial or strong. The fourth distinction or characteristic we can be able to say, number 4, is exit. Exit. How do venture capital firms or how do private equity firms exit from their investments? There is via IPO or company sale. And we are saying that this venture capital exit is somewhat unpredictable. We can be able to say it is very unpredictable for venture capital firms because it is pegged on the improvement of the business processes of the venture capital firm once the private equity firm has pumped money into it or into them there. So we can say on this side it is predictable. Here you can be able to predict out of buyout because the private equity firm outrightly owns, say for example, this asset, and it can be able to determine when it can be able to sell out this asset there. Having looked at these 4 distinctions, I think we are home and dry there. Having looked at the differences between venture capital and buyout investing.